This is gonna blow your mind. Imagine you're at a bustling marketplace, bargaining for spices, saris, or even a sturdy bullock cart. The air is filled with the sounds of haggling, the vibrant colors of the stalls, and the rich aromas of street food. This dance of supply and demand is the heart of any economy. It's a universal principle that governs how goods and services are exchanged. Just as a marketplace needs rules, so too does a country's economy. Without regulations, markets can become chaotic and unfair. In the United States, that role is played by the Federal Reserve, or the Fed. The Fed's decisions, particularly regarding interest rate cuts, have a ripple effect on your finances. This essay will demystify the concept of Fed rate cuts and empower you to make informed financial decisions. The Federal Reserve, often referred to as the Fed, is the central bank of the United States. Just as the Reserve Bank of India guides and regulates the Indian financial system, the Fed plays a similar role in the US. Imagine the Fed as an umpire in a cricket match. It sets the rules, ensures fair play, and maintains order in the financial system. One of the Fed's key responsibilities is to keep the US economy healthy and stable. It does this by managing the country's money supply and influencing interest rates. Think of interest rates as the price of borrowing money. When you take out a loan, you pay interest to the lender. Similarly, when you deposit money in a bank, you earn interest. The Fed influences these rates, which in turn affects borrowing, lending, and overall economic activity. The Fed doesn't directly set the interest rates that you see at your local bank. Instead, it sets a target range for the federal funds rate, which is the interest rate that banks charge each other for overnight loans. This target rate, in turn, influences other interest rates in the economy, including those for mortgages, credit cards, and business loans. Let's say the US economy is slowing down, much like a bullock cart losing momentum uphill. Businesses are hesitant to invest, people are spending less, and economic growth is sluggish. In such situations, the Fed might step in to stimulate the economy, much like a farmer would prod his oxen to move forward. One of the tools at the Fed's disposal is a rate cut. In simple terms, a Fed rate cut means that the Fed is lowering its target range for the federal funds rate. This action ripples through the financial system, making it cheaper for banks to borrow money from each other and from the Fed. These lower borrowing costs are then passed on to consumers and businesses in the form of lower interest rates on loans. Imagine a shopkeeper wanting to expand his shop but hesitant due to high loan interest rates. A rate cut by the Fed could lower the cost of his loan, making the expansion more feasible and boosting economic activity.
Section 4. Why cut rates? Giving the economy a shot in the arm. This metaphorical injection is often necessary to revitalize economic activity and ensure that the economy remains healthy and robust. The Fed might decide to cut rates for several reasons, all aimed at keeping the US economy on a steady course. These reasons are multifaceted and often interconnected, reflecting the complex nature of economic management. One primary reason is to stimulate economic growth. Economic growth is essential for improving living standards and creating opportunities for businesses and individuals alike. When interest rates are lower, it becomes cheaper for businesses to borrow money and invest in new projects, leading to job creation and economic expansion. This investment can take many forms, from building new infrastructure to developing innovative products and services. Lower rates also encourage consumers to spend more, as they can borrow money for cars, homes, and other purchases at a lower cost. This increased consumer spending drives demand for goods and services, further fueling economic growth. Another reason for a rate cut could be to combat deflation or the threat of deflation. Deflation can be particularly damaging because it can lead to a vicious cycle of reduced spending and investment. Deflation, unlike inflation, is a sustained decrease in the general price level of goods and services, which can lead to economic stagnation. When prices fall, consumers and businesses may delay purchases, expecting prices to drop further, which can exacerbate the economic slowdown. By cutting rates, the Fed aims to encourage borrowing and spending, thereby boosting demand and preventing a deflationary spiral. This proactive approach helps to maintain economic stability and prevent long-term damage. Rate cuts can also be used to address financial market turmoil. Financial markets are highly sensitive to interest rates, and changes can have significant impacts on investor behavior. During times of uncertainty or crisis, investors tend to seek safe havens for their money, leading to a flight of capital and market instability. This can result in reduced liquidity and increased volatility, which can harm the broader economy. By cutting rates, the Fed aims to restore confidence and encourage investors to participate in the markets, thereby stabilizing the financial system. This renewed confidence can lead to increased investment and economic activity, helping to mitigate the effects of the crisis and support recovery.
Section 5. The ripple effect, from mortgages to market moods. In this section, we will explore how decisions made by the Federal Reserve, particularly rate cuts, can have far-reaching consequences across various sectors of the economy. A Fed rate cut sets off a chain reaction across the economy, impacting various aspects of our financial lives. This decision can influence everything from the cost of borrowing to the performance of the stock market and even the rate of inflation. One of the most direct effects is on borrowing costs. When the Federal Reserve decides to cut interest rates, it directly impacts the rates at which banks lend money to consumers and businesses. When the Fed cuts rates, interest rates on mortgages, car loans, credit cards, and other forms of debt typically decrease. This reduction in interest rates makes it more affordable for individuals and businesses to take out loans. This means that it becomes cheaper to borrow money, making it an opportune time to finance a new home, purchase a vehicle, or consolidate high-interest debt. Lower borrowing costs can stimulate economic activity by encouraging spending and investment.
The stock market is another area influenced by Fed rate cuts. Investors closely watch the Federal Reserve's decisions, as changes in interest rates can significantly impact stock prices and market sentiment. Lower interest rates tend to boost stock prices, as investors seek higher returns in the equity market when borrowing costs are low. This influx of investment can drive up stock prices, benefiting shareholders and potentially leading to increased wealth. This is because companies can borrow money at cheaper rates, potentially leading to higher profits and stock price appreciation. With lower borrowing costs, businesses can invest in expansion, research and development, and other growth initiatives. However, it's important to remember that the stock market is influenced by a multitude of factors, and a rate cut is just one piece of the puzzle. Other elements such as corporate earnings, geopolitical events, and market sentiment also play crucial roles in determining stock prices.
Inflation, the rate at which prices for goods and services rise over time, is also affected by Fed rate cuts. The relationship between interest rates and inflation is complex and multifaceted. When the cost of borrowing decreases, consumers and businesses tend to spend and invest more, which can lead to increased demand and consequently inflation. Higher demand for goods and services can push prices up, contributing to inflationary pressures. The Fed monitors inflation closely and aims to keep it at a healthy level, as high inflation can erode purchasing power and destabilize the economy. By adjusting interest rates, the Federal Reserve seeks to balance economic growth with price stability, ensuring a stable and prosperous economy for all.